we're getting started. So thanks everyone for coming. My name's Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We hold events multiple times a week from San Jose to San Francisco. We have a busy calendar of events. I'd like to highlight 2 events that are coming up. Tomorrow we have an immigration workshop, and we have a distinguished immigration attorney who's going to talk about changes to immigration policy vis-a-vis Trump administration. So that's going to be at Mindrome in Santa Clara. This Thursday, we have a venture capital panel, and they're going to be discussing funding for AI startups. And that's going to be at College of San Mateo, and that's going to be a great event. So check out the details for those events and all of our events on our website, idea-to-ipo.com. We were launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 55,000 members among all our meetup groups in the Bay Area. And we've completed over 1,805 events. Not yet. By any standard, by any measure, we're the most active, most prolific startup event organization in Silicon Valley, bar none. Now, all right, I appreciate the enthusiasm tonight. That's okay. I'll take it. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff that you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley? Who here was born and raised in Silicon Valley? One person. Oh, congratulations. Welcome. But with regard to value, it's important we provide value at each and every one of our events. So we make sure that when we have a cover charge, our events are affordable. And if you cannot afford the cover charge for whatever reason, talk to me. We're always looking for people to help out at our events. And there are lots of benefits to being on our team. And at each and every one of our events, it's important we have a decent buffet meal. Was this buffet meal decent? Okay. Thank you. Tonight, by special request, we got soft tacos, so FYI. More importantly, at each and every one of our events, it's important we provide value for your time, which is your most valuable resource. Anyone here getting any younger? I always need to check. In any case, when you invest your valuable time to come to our events, we want to ensure that you maximize your ROI. And we have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, and lots of other players in Silicon Valley. Tonight, we're grateful to Ducati Digital Marketing for hosting us at this beautiful venue. Is this a beautiful venue? Yeah. Well, anyway, I want to have Philip from Ducati Digital Marketing come up and say a few words. So let's hear it for Philip.
Thanks, Rob. I'm Philip Goldworth. I'm the CEO here at Ducati. We help small, mid-sized companies grow their business through effective digital marketing strategies and helping them with marketing automation tool integration. So if anybody has any questions about that at the end of this, feel free to step up and give me. I'm happy to talk to you about that. All right. Oh, one other thing, since I'm also videotaping tonight, when we get ready, we're going to probably hold questions to the end, and I'm going to set up a microphone in the center here so people can sort of form a line, and please come up to the microphone to ask your question.
Great. We have a couple of other partners here tonight. I'd also like to have them come up and say a few words. Let's hear it first for JK and Color Software. Applause.
Thank you, Rob. Thank you for making this happen by through your continuous perseverance of running this meetup group for last 7-8 years. Thank you, Rob, and thank you, Phil, for giving this space for organizing this meetup. So I'm JK. I'm running a software development agency. It's an offshore development agency. So I'm running this for last 7 years. So we have a 50-member strong development team. we have delivered a couple of many digital platforms to our clients. So one of our client has bagged big amount of investment from AT&T, and probably they will acquire them in a year or so, the AT&T. And so our strength is software development, and we have delivered many digital solutions and we are into machine learning as well. So if you have any projects that needs to be developed, we'll be happy to help you. Thank you, Rob.
Okay, well, here's the schedule for the rest of the evening. Our presenter will present with slides. Hold your questions until 8 o'clock. At that point, we're going to set up a mic stand, walk up to the mic, ask your questions. We want to take as many questions as possible. At 8:30, we'll break, and you can hang around and network until about 9 o'clock. In the meantime, if you need to get up and use the restrooms, they're right there. There's plenty of food in the back. Just get up and go. It's no big deal. It's a pretty informal setup. So without further ado, I want to introduce our featured speaker tonight. He is one of the top corporate and startup attorneys in Silicon Valley. He's an iconic figure in Silicon Valley. You'll see him at meetups, conferences, social events. He's everywhere. He's Roger Royce. Let's hear it for Roger.
We good? All right, you can hear me. Thank you, Detati. Thank you, Rob, for asking me to speak here tonight. This is not the first time that I've given this talk. In fact, a lot of these slides I used before for Idea to IPO, quite a long time ago. And I remember when I prepared the slides, it's 3, 4, maybe 5 years ago, going through it, I thought to myself, boy, this material is kind of dry. How am I going to make this interesting? So I got a recording of Spinal Tap's Give Me Some Money, and a microphone and a loudspeaker, and I sang the whole song. And at the end of the presentation, I looked at the comments at Meetup, and people said, boy, that material sure was dry. So I think we just have to live with that. There's just a lot of very technical stuff here. So what I'm going to do here tonight, I'm going to talk, we're going to have to suffer through some of the rules. So we're all on the same page. I'm going to describe those and tell you what happened about 5 years ago when we got, about 5 years ago now, when we got the Jobs Act and the new crowdfunding law, what's happened in the regulations, what's happened in the market, and hang in there with me till the end. I'm going to talk about what's new. Talk a little bit about ICOs. Does everyone know what an ICO is? I get a call a day about ICOs, initial coin offerings, and the blockchain, and how that's changing everything, and especially what's happened in the market, because it is actually, once you get past all the minutiae of the detail, it is pretty interesting. So I want you to get in your time machine and go back 5 years, back to Obama was in the White House, the executive branch was Democratic, the House was Republican, and the Senate was slightly Democratic. And Kickstarter and Indiegogo were out there showing the world that if you had a really good idea, people would throw money at you, theoretically. And this congressman got this idea, hey, I got an idea. The crowd decides, you know, what products should get out there. For example, remember that watch? Was it Match or something? Let's let the crowd decide what companies are worth investing in. And we'll call it crowdfunding, or crowd financing is what it's called now. And by the way, when I say crowd financing, I mean crowdfunding for equity. That's what I'm talking about here tonight, how to raise money. So there was this House of Representatives bill, and it was completely the opposite of what securities laws have been for the last 80 years, which have been all about investor protection, seller beware. Crowdfunding bill was all about, let's let the crowd decide what people should invest in and allow them to invest. And it came out of the House of Representatives being this revolutionary idea for allowing people to invest if they want to. And you know, people were sitting all over the country looking at this thing we got going on here in Silicon Valley. They're looking at people making, you know, millions of dollars off Google. You know, I met this woman at a party once. She was 24 and she retired. It's a long time ago, because the first company she went to work for was this little company called eBay. She got a bunch of stock options. before anyone ever heard of them. And the next company she went to work for was Google, and she got a bunch of stock options and then retired. So the rest of the country is watching people get in on these really great deals and said, why can't we have a piece of that, right? So there was a real movement in the country for this crowdfunding idea, and that's what the bill did. Then it got into the Senate, right? The bill has to pass the House and Senate. And what the Senate did to the crowdfunding bill shouldn't happen to a dog. They turned it back into an investor protection bill. And they gave a fairly expansive regulatory authority to the SEC to go do what they wanted to do with it. And the SEC just hated this law. So they just sat on it forever. I mean, seriously, I moderated a debate between Dave McClure and some lawyer from New York, and I remember he was going on and on, like, I'm going to sue the SEC to enact regulations so we can do this. Congress wants us to do this. And eventually we did get regulations. It took forever. And we'll go into what's happened in the market since then. But we now have a structure, and we've had it for a while, and we've had some things shaking out. Now, how many of you are entrepreneurs? Pretty much all of you. Okay, that's great. So my name's Roger Royce. I'm the founder of the Royce Law Firm. We're a business corporate and tax firm. We're about 30 lawyers. We're based in Menlo Park. We have offices in San Francisco and Southern California. We do almost all tech startups. Lately, well, I've always done a lot of venture fund formation. Lately, I've been doing a lot of them. And lately, I've been doing a lot of ICOs as well. So that's my background. And against that, let's talk a little bit about the law. So this is the Jobs Act. And the idea was to just allow access to capital markets for these emerging growth companies, these startups that can't get into the market. And there were several different kinds of crowdfunding. I'm going to talk about the 3 or 4 main ones. So we're not going to worry too much about relaxing reporting for any billion-dollar companies here. Okay, we're going to skip that one. Crowd financing I do want to talk about. That's the exemption from, okay, so every securities offering either has to be registered or exempt. Okay, registration means it's an IPO, it's a public offering, trades on an exchange, etc. We're going to talk about the exemptions. So this first exemption we're not going to worry too much about. There used to be this thing called backdoor off public, become a backdoor public company. The idea was that if you have more than 500 shareholders, you're a public company, you're subject to all of these SEC reporting and disclosure requirements. That number was raised. We're not going to talk a lot about that. What I'm going to talk about, however, is what's now called Reg CF and what's happened under what we call Rule 506. So generally, Title III of the Jobs Act is the retail crowdfunding. It allows companies to raise a limited amount of funds from the general public. Doesn't mean they can solicit, doesn't mean they can advertise, they can use a portal and they can raise the money from the general public. They don't have to be accredited investors. Does everybody know what accredited means? So generally, before this, and even now, in order to sell securities, you again, remember, registered or exempted. To be exempt, we used to rely on what they call Reg D, which is a safe harbor. And there was various exemptions under Reg D, which were called rules, Rule 504, 505, 506. Rule 506 is the one we always rely on, because that's the safest if we can. And under Rule 506, it said, you are exempt, and you don't have to meet these onerous disclosure and reporting requirements if you only make offers to accredited investors. Right? So you only offer the securities to accredited investors. And under the old rule, which still exists today, the accredited investor can self-certify. They fill out a little form that says, I'm an accredited investor, and you're done. Unless you obviously know it's wrong, right? If they're, living on the beach and, selling seashells, and maybe they falsified the form, because accredited had a net worth or a net income requirement. To be accredited, you had to have at least $1 million of net worth, or you had to have annual income of $200,000 a year for the current year and the prior 2 years, $300,000 jointly. That rule was recently changed as part of about the time of the Jobs Act, so that that net worth requirement excludes a personal principal residence, right? So that's accredited. And by the way, this is a definition that came around in the early 30s. It hasn't changed much since then, other than this residence thing. So back in the 30s, accredited and rich, right? Today, it doesn't really mean that. It means there is this fairly minimal net worth or net income requirement. So what crowdfunding Title III says is, okay, so that's Rule 506. So when we do an offering, if we sell to too many, if the size of the offering's too big, or if we have too many unaccredited investors, we got to provide an extensive amount of information. You got to pay your lawyers a lot of money. You got to do a lot of work. What crowdfunding says, look, we're going to make this really easy to sell small amounts of stock to a bunch of non-accredited investors. That's the idea. Then the other thing that changed, I'm really going to talk about 3 of them. The other thing that changed was Title II. This is the idea that, remember what I said, you can do a private offering, you can sell as much as you want to accredited-only investors, but you know, you can't solicit, you can't advertise. So while everybody was really focused on Title III, it's like, wow, my startup can go out and sell money to my barber and to my hairdresser, you know, and anybody I meet on the street, that's great because they don't have to be accredited. Title II is the really big change, because under Title II, you could publicly solicit the sale of your stock, provided that you only actually sold stock to accredited investors and you verified, okay? So the verification thing, the SEC eventually got around to giving us regulations on what verification meant. They were a little tougher than we would have liked and a little more vague. It's sort of a facts and circumstances test. But I'll tell you where we are today. It's because of that rule that you've seen all these online VCs pop up. And some of them do, and it's 506B and C's, 2 different subsections. But some of these online VCs do the type where you can sell to as many accredited investors as you want, and they can self-certify, but you don't advertise. Or you sell to accredited investors and you do advertise, but they verify for you. Those are 2 different models. And there are platforms, portals out there almost immediately that popped up selling securities under these exemptions. And those are the ones you've been hearing about. Those were really big names. They did the big deals. That's Funders Club and Angel List. And I'll talk about a few more, but Our Crowd from Israel, that was a big one. So different models built around that. And then the third thing was what they call Reg A+. And this is for a company that wanted to raise up to $50 million in like a mini IPO. I've had a lot of fun talking about Reg A+ over the last 5 years. I've never done one. I don't know anybody who has. I've heard they're out there. But it was an interesting idea, but I'll tell you why I don't think it's very useful. Okay, let's talk about Title III, crowdfunding first. Again, just suffer with me through some of the detail, then we'll get into the some of the fun stuff. So the idea is that if you're a private company issuer, it's up to $1,070,000 now, but it started at $1 million. You can sell that $1,070,000 worth of securities over a 12-month period to individuals. They don't have to be accredited, but we have these fairly strict limitations on how much they can invest. So you're going out and getting lots and lots and lots of people putting small amounts of money into your company, kind of the way you would do a Kickstarter campaign, right? Kind of like a crowdfunding. You're doing it with your equity securities. That's the idea. So the problem with this, of course, remember what I said about the Senate really turning this exemption into a difficult thing, but just pause on this. So if you had $107,000 of annual income or net worth or less, then the amount you could invest was the greater of $2,200 or 5% of the lesser of annual income or net worth. Okay, so you can see you have to go through these calculations, but you can see it's relatively small amounts. So the problem with this is that you could raise $1 million on this, But look at all these rules you had to comply with to go out and raise your measly $1 million, and over at $1,000 a pop. You know, was that 1,000 investors? So that you had to have an intermediary. Had to be FINRA registered. That means broker-dealer, or somebody who registers with FINRA as a portal. There were all these rules about how many, about not allowing multiple, concurrent crowdfunding offerings that they had to regulate. There were these good actor rules, right? You couldn't have had any sort of bad acts in your background with the SEC. Communication services between the investors. The ones I'm not mentioning here had to do with audits. If the amount that you raised exceeded certain amounts, you had to get audits. Audits are expensive. Brokers are expensive. Lawyers are expensive to do all this. You did have to file a disclosure document. It wasn't like an IPO, but it was relatively expensive. The fact is the transaction costs were really high. And they are. They just are. The transaction costs are high for these sorts of offerings. And we have these other rules about integration. We had to be careful that we don't infect some of our other types of offerings. And I don't want to get too deep in the weeds on this, but there were lots and lots of rules around this. I don't even carry this around in my head. There's too much of this. Limits on advertising. Limits on resale. You couldn't resell. The biggest thing, though, for me as a lawyer, the biggest reason when I read this law and I looked at it, I said, not me, I'm not getting anywhere near it, is that this expanded liability. Because in the securities law, there's this thing called anti-fraud liability, where generally under Form D, you can be liable for securities fraud if you make a material misstatement. It's something very much closer to strict liability under Title III. There could be a private right of action, and anybody involved in these deals, including the lawyers, could get sued if there was even an innocent mistake. So, I thought it was problematic. Here are the audit requirements that I was talking about. And audits are expensive, so if it's more than $500,000, you have to get an audit. You got to get a review if it's over $100,000. We had to file those SEC reports on Form CAR, which I have done. What else did we have here? And then filing of updates. So there's fairly extensive filing requirements. A lot of rules around this. So I hate to just make it all sound bad, but I just want to give you a sense as to what we had. Now, despite all that, companies are out there doing these deals. And you know about WeFunder, right? And we know about Start Engine. And there are some platforms, ever since we got implementing regulations a couple years ago, that have actually been very successful with this, and there are some very reputable platforms. There are also a lot of platforms that did not do so well. Does anybody here operate a platform? Okay, there are a lot of platforms that were just dogs, They were a market for lemons. And some companies, I had talked to VCs and investors about this, and they were really cautious about this. They say, first of all, don't go on a platform unless you absolutely know you're going to succeed. And don't go on the wrong platform. You don't want to be sitting there next to a bunch of companies that didn't succeed. You want to be sitting there next to companies that raise lots of money. And it's public, everybody knows, so you want to make sure you raise money in this. In fact, my most successful ones of these is companies that use this as a marketing tool, campaign. They had the money lined up. They knew they were going to raise the money. They just used a crowdfunding platform as a way to let the world know that they could go out and they could crowdfund it and people would invest in them. So that's an aside. But anyway, despite all the problems, we got regulations. We got some very good platforms that managed to work around those and were able to go ahead and fund a lot of companies at this smaller level. Now, I want to mention that there have been some proposed changes because what I gave to you, all those problems, we now have, remember, when this was passed, Democrat Senate, Democrat House, right? I'm sorry, Democrat White House, hostile SEC, and I do mean hostile. Everything's changed, right? Republican Congress, Republican Senate, Republican White House. An SEC that we all expect will be a little kinder and gentler to the concept of freedom of contract and securities law. So we've got a few things that were floating around last year. This year we've all been distracted by Twitter wars and such, so we haven't gotten around to it. But these ideas are going to come back up again. Small Business Capital Formation Act, Supporting America's Innovators Act, the Fixed Crowdfunding Act, the Fair Investment Opportunities for Professional Experts Act. The one I want to mention, the Fixed Crowdfunding Act, is the most interesting one because that's the one that would really loosen up and do away with all of these onerous restrictions that make it really expensive to do these crowdfundings. The most recent one, the Crowdfunding Enhancement Act, would raise the funding cap to $5 million, so it's worth incurring an audit cost or transactional cost. It would get rid of this liability issue that scares the heck out of me, so I'd be willing to help on one of these again. We can talk about SPVs if you want to, but just suffice it to say that an SPV is a special purpose vehicle. People would pool their money into a special purpose vehicle and have the vehicle invest in the crowdfunding. The SEC thought that was so abusive, because you would get around all these limitations on number of investors and things. And it would revise SEC registration requirements, so we wouldn't have to file all these forms. That's what that particular act would do. The thing that it doesn't help with, though, so I've told you all about the federal law. The thing we always have to think about in securities in the United States is it's never one law, it's federal and state. You gotta think about what the states are doing. Some states were very receptive to the idea. They enacted their own crowdfunding laws. I forget the number, but one time I knew what it was. And I've worked with a couple of them. I worked with Oregon, for example. And if you did a wholly intrastate deal, it was like doing a crowdfunding offering here without all of the BS, without all of the federal stuff, audited statements, and disclosures, and filings, and liability. It's very tricky to do that because you'd have to do that within a state. So that's one thing that happened at the state level. And I had companies in some states that allowed this that did very successful crowdfunding campaigns. The other things some of the states did, though, however, is they really hate the idea of these being listed securities that are exempt from state blue sky requirements. So one of the things that makes this work as a federal matter is that you don't have to, you don't have to jump through all the hoops of a state like California. California is not even the worst. It's one of the East Coast states, for example. But jump through all the hoops of a state blue sky, a state securities law that makes it really, really hard, to buy and sell securities. There's federal preemption, so these securities were exempt from those requirements. But what the states did, and not many people realized this until they got deep into it, it's kind of surprising how many people were surprised by this. The states can still require a notice. Now, notice can be pretty expensive. Right? So you get out in the eastern states, and you can pay $500 for every offering, just because you have to give them a notice. So we got the state rules to deal with. And I think anyone who does this is going to either do this in a state that tolerates these deals or expressly offers it, and not in a state that's going to be hostile and require an expensive notice. There was something else I wanted to tell you about that. We'll come back to it. Okay, some data. My data is a little dated, a little old, but you get the idea. So as of the end of last year, 2016, only 169 companies had filed that Form C to actually do this offering. It's way more than that now. A lot of companies have done this. Average raise was $100,000. Average maximum raise was $647,000. By the way, you guys are all startup entrepreneurs, right? What do you think the average age is of a company that does one of these types of offerings? Is Title III up to $1 million, $2,200 at a time? What would you guess? That's pretty close. It's about 2.5 years. Right? So they're a little further along. They tend to have revenue. They tend to, they don't have income. They often, usually, the median is a loss, but still their companies have a product they're out in the market. And if you think about it, what would be the right kind of company to do this, right? It would be like an affinity company, a company where you kind of get what the product is, like the company selling watches. You know, we all know what a watch is. That's pretty cool. I would put some money in that. I would buy that product. I get it. I understand it. So those sorts of companies tend to be a little further along. Here's another one for you. What do you think, which state do you think has done the most of these? No, I mean where the companies are located. Yeah, they're all incorporated in Delaware, no doubt. Well, that's another question. Do you think they're corporations or LLCs? So California's done the most. California's done about a third of them, or companies based in California have done about a third of these. They tend to be corporations. And here's another interesting, they tend to be corporations, they tend to be Delaware. I'm sorry, they tend to be corporations, they tend to be based in California. I think they're affinity type products. They tend to have revenues, about 2.5 years old. Oh, there we are, Delaware entities, and they tend to be formed in Delaware. Yeah, Texas has had a bunch of them as well.
What's the minimum age allowed?
The minimum age? Oh, you can, as soon as you form the company, you can do it. There's really no minimum age. What do you think the security is that is most often sold? Right, it could be stock, could be convertible notes, could be safes. You know what a safe is? Oh, we're going to talk about safes. It is safes. Simple agreement for future equity. So let me do a sidebar here. Financing in Silicon Valley. In the old days, back when I started doing this, when dinosaurs walked the earth, we had preferred stock and we had common stock. And back then, it was before Web 2.0. So if you're going to do a financing, you had to raise millions of dollars. You know, you couldn't go out and buy a website from our friends over here for a very small amount of money and be up and running tomorrow. You know, you had to hire a team of people. So financings were large, and that justified the relatively high transaction costs of negotiating preferred stock financings. Then Web 2.0 came along, and companies didn't need $10 million to launch. They could launch on 100,000, or 500,000, or something like that. So if you're going to raise a couple $100,000, it's hard to justify giving someone like me $10 or $20 or $30,000 to do the documents, right? So we came up with convertible debt. The idea was, I'll tell you what, I'm the investor. I'm going to loan you your $100,000, and you give me back a note. That note will automatically convert to preferred stock when you go do your big round. And that way, I don't have to try to value the company now because you're so early, and you don't even have revenue yet. You don't have a product. Plus, I can piggyback off of the valuation that those big bad VCs are going to get from you, because I know they're going to beat you up on valuation. That's a convertible debt, and they're going to give me a discount for getting in early and some other bells and whistles. Well, the problem with that, and I tell you, we've all had to live through this. Some things, they say the life of the law is experience. Sometimes you just have to live through it to see how it plays out. I've had several companies that the investor ended up owning the company, because the problem with debt is that it has to be repaid. If it doesn't get repaid, they sue the company and take the assets. It also has to pay interest. Maybe the company, and really, if you think about it, it was equity risk they were taking. Why call it debt? It's really equity. If the company fails, I'm probably going to get nothing. If it succeeds, I'm going to convert and get a huge upside. It's not really like debt. So the idea of a safe came along. And it's also the KISS instrument, keep it simple solution or something. So this is like convertible debt with equity, though. It's convertible equity. So I'm the investor. I don't loan you. I give you $100,000, and you promise to give me $120,000 worth of stock, preferred stock, when you do your financing, but you don't have to pay me interest. If you don't do the preferred stock financing, you don't owe me anything, right? I'm betting you're going to get financed, and you don't have this big liability to me, this note. That's a safe. Makes sense. all we're doing is delaying that valuation decision until we can get a VC involved that can beat you up in valuation and let me piggyback on what they got. That's what most of these deals have been. They've been safes. Put a pin in that, because I'm going to come back to that. Because, and by the way, is a safe a good thing for you as a company, you think? If you're negotiating with the investor, do you rather offer them a safe or a convertible note? I'd rather give them a safe. You don't have to pay interest. Don't lose your company. You know, you don't have to pay it back if you don't get financed. If you're the investor, you'd probably rather have the note, theoretically. But let's be honest, if the company doesn't get financed, there's not going to be money to pay your note either, right? So the safes are really gaining in acceptance. All right. Let's see a little more data. Well, I don't know if that number is more or less. WeFunder is the biggest one. Start Engine, I didn't think they were second, but I know they're big. And then there's a few others. But you can see there are a couple of dominant players. A couple of dominant players that figured it out, they nailed it, they got the technology, they lowered, but by the way, the costs are still pretty high, and they admit that. And they tell people that. You're going to pay 6% probably to do $1 million crowdfunding. But that's who's got the market now. I think I've met the guys at Start Engine. I did a panel with them. I think they're an impressive bunch. And they are right in front of this. In fact, they're willing to go crowdfund ICOs. I'm going to talk about in a minute. Or offer ICOs, initial coin offerings, or initial token offerings on their platform. By the way, a lot of portals didn't make it. You know, a lot of brokers went out there, big, flashy, press releases, news, posted a bunch of logos on their website. Didn't raise any money for anybody. One of them that I know of converted to a real estate crowdfunding portal, but I think the market's pretty much settled. Oh, here we go. Yeah, agreement for future equity. That's the safe. That's got 19% of these. It's probably more than that. Oh, I'm sorry. Common stock was more. Yeah, well, other than common stock, the safes. Because if you're a small company like that, it's easy just to sell common stock. Okay, then the safe instruments. Actually, if you add, I take that back. If you add the crowd safe and the agreement for future equity together, that's more than common stock, isn't it? So I was right the first time. Kind of makes sense. You know, if you're an investor in one of these small early companies, you probably don't want to be valuing the company. Very little preferred stock, you'll notice. Okay? So, again, we all know what crowdfunding through donations is. It's Indiegogo, Kickstarter, those sorts of issuances. If you are going out looking for money, that would be a good place to start. Let me tell you, I've done a few of those, and what I want to mention about that, just like equity crowdfunding, you want to be absolutely certain that you're not going to have a failed crowdfunding campaign, even on Kickstarter or Indiegogo. And again, companies I've seen that have been successful about this, they had the thing wired before they, whether it's equity or whether it's rewards-based or donation-based. They had it wired before they started anything. They knew that they were going to raise their money. So they could tell the market, look how popular we are. And if they didn't know it, they wouldn't have done it. Because and that's what I've heard VCs say on panels, when we talk about, hey, how about we go raise some money this way? And they're pretty wary about it, because that could be the death knell for a company. So be really careful about this. Strategize, think it through before you do that. I want to point out, a lot of people make this mistake. They think, oh, I can crowdfund. That means I can advertise. You really can't under this Title III stuff. The costs are high. I have to use an intermediary. All these other issues I've already talked about. Now let's talk about 506. And this is the one, like I say, I think is way more interesting to me, because we don't have to have audited statements. We don't have to file these disclosures. We don't have to do all this stuff. We don't have really small amounts that we can raise. The only thing is we can only go out and raise money from accredited investors. Now, here's the way to think about it. There's 506B, there's 506C. 506B is the old way where you cannot advertise, but you don't have to verify. You can take the investor's word for it. So there's several platforms out there that rely on 506B. I hope I don't have slides boring you with how we get there, but trust me, they're out. Right? They figured it out. And there's 506C. You can advertise, but you have to verify. So if you want an idea for a really good business, get into the verification business. Because there are a lot of companies out there now that will just do that. How do you verify? Like if you're a company and I'm coming to you and I'm saying, I want to invest in your company, and you've advertised, and I saw your ad, and now you know because you advertised, you have to verify that I'm accredited. How are you going to do that? Well, some examples in the regs say you can ask for bank statements, you can ask for tax returns. I don't want to give you my tax returns. I like your company a lot. I want to invest, but I don't want you having my tax returns. So there are verification agencies that you can rely on. They will look at my tax return and they will go to the company and say, we verify that they're accredited. Okay, they're out there, they're doing well, it's industry standard, that's how we all do it now. First couple of years we didn't. I've been asked to hold questions until 8, so we at 8 yet? Nope. Okay, let's keep moving because yeah, so here are some of the ways that you verify tax returns, like I say, bank statements. Oh, get a note from your doctor, or your lawyer in this case. A note from your lawyer or your CPA or investment advisor that says we've taken a look and we'll give you our opinion that they are accredited. Now, I do want to mention that there are these proposed rules out there under this 506C exception that I really love about going out and advertise. And when I say advertise, I mean advertise. I mean you can put ads in the paper, you can start calling people, pester me at home on my cell phone, you can skywrite, do whatever you want. That's advertising. That's 506C. You really can. It's really revolutionary as far as securities laws goes that this came along. There wasn't way more noise about this. Because just think how big the universe of accredited investors is that you just don't know about. I do a lot of work with VCs and with angels. And I will tell you the VC part is way easier. I go to their website. I know who they are. I know what they're investing in. I know how much money they've got left to invest. It's all on their website. They'll tell you about it. They're out there at events like this. Any VCs here? Well, they're out at events like this. Angels, they're not advertising. They're not telling people who they are either because they don't want to be mobbed. It's really harder to reach those people. You kind of have to just live here for 30 years and know who they all are. This exemption allows you to go advertise so the angels can find out about you. That's why some of these sites have been doing so well. I think it's really a great thing. Now there are these proposed rules that are going to make it a little more onerous by requiring filing forms. But it's not a big deal, but just something to keep in mind. If these rules become final, we'll have to file these forms, filing solicitation materials, things like that. Putting a legend on the securities that notifies everybody that it's been sold pursuant to this exemption, can only be resold to accredited investors, things like that. So, private offerings, what else can I tell you? I want to talk about the no action letters. Because this is sort of interesting. Remember those websites I was telling you about? And everybody talks about these 3 private action letters. Really these 2, AngelList and Funders Club. And the question was, so let's suppose that so what AngelList and Funders Club did is they've got these websites and they match investors with companies on their websites and they're both very successful. And they advertise the fact that you can go onto their website and join AngelList. And they also tell you what companies they're matching. So the way this came up is, gee, are they a broker-dealer? But the bigger question is, are we going to impute this advertising that AngelList is doing to the company itself? And these no action letters are really interesting because they put in place some rules that the industry abides by as to really how long somebody has to wait from joining AngelList, for example, online and investing in one of their companies. Because the rule for broker-dealer is that you have to have a pre-existing relationship with the company. So if they join the website today and invest tomorrow, they probably didn't have that pre-existing relationship. But if they join the website and they waited 30 days, now they got a pre-existing relationship with AngelList. Now AngelList can put them into the deal. That's probably way more information than you wanted. I just want you to be aware of it because those are the rules we all live by. Let me talk about a couple things since we're getting close to the end here that would be interesting to you. Pitch competitions. I host pitch competitions myself. I know Rob does, or used to. They're all over the valley. And in the old days, they were public, they're open, and people would stand up here, probably you guys, and you would say, I'm so-and-so, and I have parrotfood.com, and I'm raising $1 million, and here's my valuation, and this is my preferred stock, and come and see me, here's my prospects. You just can't do that anymore. You never could, really. But now you really can't. Now, awareness has been raised. That is a public solicitation. The reason it's a bigger deal now than before, because if you do it now, you have basically elected into that rule 506C. That's your only exemption available for at least 6 months, because that's the integration term. So you've basically elected into that rule. So I do pitch competitions, and I actually make people sign a form that says, I'm not going to tell people I'm raising money. If I do, I understand I'm in 506C, and that's the only way I'm going to be able to raise money. So be really careful about that. Pitch competition should really be a demo day, right? You should get up and talk about the team and the product and the market and how you're going to change the world. You should not talk about anything that looks like the sale of a security, because that's a public solicitation. Or it's got to be a private group. This is probably a private group. You have to pay to get in. It's limited. Not anyone can walk into this. So, but even with a group like this, I'd be awfully careful. And yeah, it's a death penalty for early stage companies. Because once you publicly solicit, you're just locked up for the next 6 months. You have to verify all of your investors, and they can only be accredited. Right? So be really careful about this. I have some fairly extensive documents on this. If you want to learn more about what you can and can't say at a pitch competition, leave me a card, and I'll send you all these slides. Whoever wants them, just leave me a card. But I especially have a memo on pitch competitions. You'll probably find it on our website also. Intrastate crowdfunding, yeah, I've already talked to, 32 states as of 2016, I'm sure it's more now, have legislation that allow intrastate crowdfunding. So if you're, Oregon's the one that comes to mind because I most recently did Oregon. If you're an Oregon company and you're raising money in Oregon and you sell and you solicit only to Oregon residents, so it's intrastate, that's a federal securities law exemption, so you're not subject to all these other rules. And Oregon would allow that. It hasn't been very useful for me, to be honest with you, because not many companies can make absolutely sure they stay within one state. And it doesn't work in California anyway. Briefly, Reg A. If you think this other stuff was dry, let me just kind of cut to the chase. It's a mini IPO. You raise up to 50 million. Normally you do an IPO. It's a very expensive process. You file extensive disclosure documents. You go through a long period of due diligence. You better be raising a lot of money to justify the millions of dollars you'll spend doing it. Reg A Plus said, how about we have like a mini IPO where we raise a smaller amount of money, but we don't make them go through such a big compliance burden. That's Reg A Plus. It's not perfect because there are some state preemption issues. You still have to comply with state law. And the biggest thing, though, is that it's still relatively expensive. I mean, you still have to, it's a mini, it's light, it's IPO light, it's a trimmed down disclosure document, but you still have to file it. And my experience has been is people who want to raise $50 million in Reg A Plus will just do the IPO if they're going to go to all that trouble. That was before initial coin offering, so I'm sure I'll talk about in a second. Before I do, I want to summarize. That's Reg A. That's not what I want to summarize. This is what I want to summarize. 506B, 506C, and Reg A. So I'm not worried about what we call Reg CF crowdfunding, $1 million, so we talked enough about that. But if you're comparing Reg 506 and Reg A Plus, I've got a handy little chart here that tells you what the differences are. And you can see, million rules that we have to comply with. I won't put you through them because I want to talk about this. Okay, so everybody know what the blockchain is, how it works. I'm still not sure I do myself, but I tend to get the general idea. So it's the distributed ledger. So you think about it, and Delaware now is a blockchain project as well for their securities. So the way I think about it is that what we're really talking about is technology. And so there was a time when a company sold securities, it issued this big paper, this big certificate, and it gave you the certificate, and you walked around with your stock certificate, and you presented it to the company, when it was time to sell, or presented it to the buyer. And suppose we go one step and we say, well, I'll tell you what, how about we just have the company keep a ledger? That's a technology in a way. Doesn't change the fact that you bought a security. Now let's suppose we go one step further and say, how about the company keeps an Excel sheet of all the owners of stock and records the transactions. Doesn't mean you're not selling a security when you sell your stock on that ledger, even though you don't have a certificate anymore. It's just a technology. And that's kind of how I see tokens. Right? It's just a technology to enable something else. Now, so an ICO, an initial coin offering, is a sale of tokens, and they can be utility tokens or security tokens. Did I say that anywhere here? And the idea is that the token, think of it as a sale of a cryptocurrency. And people can buy it with fiat, which is cash, or they can buy it with other cryptocurrencies, right? And it runs on the Ethereum platform primarily. So the reason this is what's happened, and I get a call a day about this. We're doing a ton of these. The reason this is really interesting is that the SEC last July came out with a ruling about the DAO token offering. And what the offering was again, it was a cryptocurrency that was being sold. So someone was offering a cryptocurrency just like an IPO, only they were offering the sale of this new currency that they had created. But this new cryptocurrency, this token, not only was it a currency, but it entitled the recipient to some share of profits of an underlying business. At a high level, that's what it did. SEC looked at that and said, wait a minute, that's a security, right? And if it's a security, it's subject to regulation by the SEC. All these rules I just talked about apply to it. Most of these deals are securities. Most of them are. So much so that Start Engine, who I mentioned, is offering ICOs on their platform. And their position is they won't do one that's not a security. They think they all are anyway. So let me walk through that again. Let me give you a good example. So a token, let's talk about a utility token. Utility token would be this electronic, it's a blockchain really. It's a smart contract. That's how I think of it. Utility token is a smart contract that entitles the holder to some benefit, right? I guess I could sell utility tokens for legal services, all right? Well, that's not a security, but if instead I sell somebody a smart contract token that gives them a percentage of my revenue, from legal work, well, that's a security, because the definition of security necessarily it relies on profiting from the efforts of somebody else. So that's kind of the basic distinction. And when it comes to tokens, it gets to be, the way these tokens work is that, gee, you get the token and you're going to ride up the value like Bitcoin, it's going to be a huge success. But also at some point, you're going to get some share of some measure of something I've done. Maybe a share of profits from my business. Maybe a share of revenue from something that we've done. So it's very facts and circumstances intensive. Okay, I will tell you, I've done these that are purely utility tokens, and there's no securities. We're very comfortable with that. And I've done these that are very clearly securities. Most of them you have to kind of think about it and kind of work your way through it. Because most of them are tied, because that's where their value comes from. The fact that you're going to get some dividend on the back end someplace. That's where the value comes from. So here's the thing about these ICOs. There's a bunch of things to know about Number one, the SEC has spoken, given us rules. They told us if this, that, and the other thing, then they are a security and they have to, just like selling stock. A lot of other countries have not. Okay, so other countries have been pretty liberal about it. And a lot of people are doing these offerings in other jurisdictions because of that. I kind of like the fact that the SEC has spoken because even though we might not like the ruling, we've got rules that we can live with. Other countries, who knows what the law is, how they're going to view this. So number one, we've got some guidance. Number two, there's tremendous potential for fraud in these things. I'll just tell you, and there are a lot of schemes. A lot of people come and they talk to me and they say, gee, I heard about someone tried to sell this to me. It's a total fraud because if you stay away from the security definition, then you're totally unregulated. Who knows what you're buying? And when I say fraud, I shouldn't say it quite so. Sometimes people are looking fraudulent, but when things go wrong, it's oftentimes just because of, something less than fraud. Inadvertence, wasn't thought through very well. The business model didn't work, wasn't vetted, would not have passed. If they had told you all the facts, you wouldn't have bought it, that kind of thing. So a lot of people are coming to me now and they say, well, gee, since the SEC is going to regulate this, I definitely want to give people a share of the profits of not only the appreciation in the token, and not only the utility, the right to use the service that the token represents. I want to give them a share of some of the profits maybe from all the tokens I sell, maybe a share of the appreciation on all the tokens, whatever it is. So it's clearly a security, but I heard about that SEC rule. So you know what? I'm going to set up a Cayman Islands corporation, or Seychelles, or Australia. I heard Australia today, and I'm going to sell them to U.S. individuals through that entity. What do you think? Do you think that works? Does that get around the securities rules? No, that does not work. Because the question is, who are you targeting? Where are you making those sales, and who are you selling to? So if you're sitting here in the United States selling them to U.S. people, you're going to be subject to U.S. rules. So what that company has to do, they have to go one step further and put in place a restriction that guarantees that they cannot even sell one of these to a U.S. person. And that's what they do. And they do that through figuring out where the IP address, through the IP address, where the purchaser is located. So this area of law is moving really quickly, and it really comes down to the securities issues when we put these in place. I mean, I told Robbie I had to do a whole session on this. I could talk for an hour about the process, the white paper, the PPM, the pre-sale, the safes. There's a safe T for tokens, the way we do this. What I want you to take away from this is that this is the new crowdfunding. This is the new crowdfunding as ICOs, tokens. It's completely overheated right now. I mean, there's tremendous activity in the market. It's going to settle in. There's going to be winners and losers. Just like there were winners and losers under Title III crowdfunding, there's going to be winners and losers here. Pick a winner if you're going to do this. And we haven't seen the last of all the regulations that are going to come up. I've told you about securities. There's also, if they're futures, they're regulated as a commodity. So we'll see CFTC regulation. There's also FinCEN, money service business, if they're a cryptocurrency. So lots of rules around this. Closing, if you want to know more about all of this stuff, you should buy my book. Or if you give me a card, I'll send you an electronic copy. And certainly my sequel will have a lot more about crowdfunding and ICOs. But in the meantime, you can always find me at one of these locations or by email. And we're at 8 o'clock, so I'm going to thank you for your time and attention and turn it back to Rob.
Let's hear it for Roger. So at this point, we'd like to take as many questions as possible. So if you have a question, just head on over to the microphone. And if you have a follow-up, you might want to stay there because that way we can have a decent audio for our video, which will be made available to everybody in a few weeks. So who's got a question? Step right up.
I have two questions. Initially, one of the slides you mentioned, there's a breakdown of different equities, how they're broken down in crowdfunding. There was a future equity and there was convertible note. The other ones were understandable. What is the next one?
That one?
Agreement for future equity. What is that?
That's the safe. That's the safe. That's the
So you have CrowdSafe too, and so it's the same thing. CrowdSafe is.
CrowdSafe is a safe instrument that was developed by one of the crowdfunding portals. It's
Okay.
targeted specifically for crowdfunding.
That was the.
The terms are a little bit different, but it's
Alright,
the same general idea.
So the question I have is, you go through this crowdfunding campaign, you raise some money because you want your seed money and get your business going. But eventually when you start raising your round, how do investors look at that? Do they look at positively that you raise money through?
Thank you for that question. That is an excellent question. In fact, I'm embarrassed I didn't talk about that myself without being prompted. What's that? Yes, the question is, how are your investors, your later investors, I assume you mean, going to look at the fact that you've done a crowdfunding offering? And I've actually had some arguments with Dave McClure over this, who thinks that this is wonderful. But I view, as a lawyer, I view every shareholder you have as a potential plaintiff. And I'm awfully careful about my companies when we do financings that we know who our investors are and know that they're not troublemakers. I've gone so far as to tell companies, I'm not making this up, don't take money from that guy, he's a lawyer. He may sue you. You know, I know him. He's that kind of guy. So when you go out and do a crowd financing, you got all these strangers. First of all, you don't know who they are, they don't know you. They're getting minimal disclosures. They're probably not sophisticated. They don't really understand what they're buying. And I've dealt with unsophisticated investors. I know how frustrating that can be. I've had people come back, even people who are smart, they can be smart but unsophisticated. I've had doctors, you know, heart surgeons come back and say, I lost my money. Well, how can that be? You know, you said you were going to make money. You better give me my money back because you said you were going to make money. You know, they don't get it. So you're going to go out and open us up to the universe of people who think that way. And they're going to be unhappy and they're going to look for reasons to sue you. That's kind of how I look at Title III. Unless you got a really good disclosure document, you're really careful about your audits, and you really dot all the I's and cross all the T's. But I got to tell you, it's seller beware, securities. So I think a later investor is going to come along, and I've had this happen. They come along and they look at that and they say, boy, I don't know, it's kind of risky. What happened? I don't want to give you my money just to give it to a lawyer to defend, you know, the securities fraud lawsuit that you're going to have. So I say you have to factor that into account. If you know you're going to do a later round, and even like on the panels we've done, when I sit with VCs and crowdfunding comes up, they all kind of, let's try something else. So Title III crowdfunding, where you're raising small amounts of money from widows and orphans or whatever, I think you have to be very careful about that. That you've got just the simplest, cleanest, you know, spotless company possible if you're going to do that. Now the other type of crowdfunding, 506C, the accredited-only, I feel a lot better about that. Because even if you don't know these people, they are sophisticated, or at least they're rich, right? So they must have invested money before. You know, they must understand that, you know, there's a lot of risk in these deals. So, and it's going to be hard for them to go tell a court, you know, that, oh, I didn't know, I didn't understand. Although I have had that happen. In fact, I have one guy, I can't tell you his name, but household name, billionaire, you know, invested, didn't do his diligence, you know, company didn't do as well, and he came back and said, you took advantage of me, I didn't know, I didn't understand. And I remember talking to his lawyer, I said, are you really gonna go tell a jury that your guy didn't understand all the money he's got? They said, no, we're not gonna do that, and they went away. But that's why I like accredited investors. They're, you know, if they're not actually smart enough, you know, it's going to be hard for them to go claim that they're not. But I digress. So my answer is Title III, I think it's a little risky if you're going to do a follow-on financing. Title II, which is the accredited only, I'm totally on board with that. In fact, I would say that Title II is filled in this huge, we used to call this, we still call it the valley of death, you know, between that pre-seed round. I do a whole program on financing we should do, and how the evolution of companies. And, you know, you get the founder money first, and they go pester their family, you know, friends and fools. And, you know, you do the pre-seed round, and maybe they even get some angel round, but then they got to get to Series A. And there's a huge gap. If you just look at the numbers of amounts, companies, the number of Series A financing versus the number of pre-seed, a lot of those companies are not getting financed and they die right there. Well, crowdfunding has filled it, and it actually has. I'm not theorizing. It has filled in that gap. I got another slide I should have included as to the amounts of money through crowdfunding over the last 5 years. And it's just on this, it's on this kind of spiral up every year. It's really filled in the gap because it's unlocked billions and billions of dollars from accredited investors across the country who otherwise would never have known about these deals. It's just imagine you're a rich farmer in Nebraska. You'd love to invest in a high-flying tech company, and you got extra money to do it, but Silicon Valley is a long way away. You're not going to come to one of these events and meet any of these companies. With this kind of crowdfunding, you can find them right online, and you can invest, and they've been doing it. So I think Title III, yes, it's an issue. Title II, no, I don't think people worry about it. I think it's a good thing. Yes, sir.
Can we get a copy of your presentation, or will this be online?
Yes, just leave me a card and I'll email. Maybe Rob will send
Well,
it
just
to you.
email Roger directly and he'll get it to you.
Yeah, the question with the crowdfunding, just make sure I'm correct about that, they do not get a board seat, nor do they have any voting privileges, correct?
They do have voting rights, but they're not going to get board seats or anything. These
Okay.
are teeny amounts of money.
Okay.
And it's a small raise, too. Keep in mind, it's only $1 million.
Can convertibles or safes be offered to non-U.S. citizens?
Can convertibles or safes be offered to non-U.S. citizens?
Through
Yes.
any of these regulations, and if so, which ones?
Okay. No, one of the requirements of crowdfunding should be on this long list of requirements. Well, it's got to be a U.S. company, but it can be a non-U.S. investor, sure. So yeah, you can offer, you mean for a U.S. company? Yeah, you can.
U.S. company, non-U.S.
Yeah, we do that all the
investor.
time. So the real issue with that is not, that's not a problem. Well, there's a couple of issues. The big one is tax. So if it's a safe, it's not debt, so there's no interest. But if it's a convertible debt, then interest has to accrue. Under the tax regulations, a portion of what gets paid will be treated as interest, and the tax law imposes a withholding obligation on any interest that gets paid. Now that might be abrogated by a tax treaty, but that's a big hassle trying to claim that. So there's a tax issue with having foreign investors, but it's not a big deal unless you're doing debt. And even then, it's just a little bit of withholding on the interest portion. The other issue, here's one you'll like, because I had this come up. I have a company that issued a bunch of safes to a bunch of Chinese investors, like $1 million worth. And the big investor finally came along and said, I'm a little worried because of Donald Trump. Well, what has Donald Trump got to do with this company? He said, well, what if the new government starts cracking down on Chinese-owned companies? And are they going to let this portfolio company do business with the government? Because you have all these Chinese owners. So we had to go around and buy out all the Chinese investors before the new guy would invest because he was so concerned about it. I can talk a little bit more about that. Just last week, the Trump administration has blocked its first Chinese acquisition under what they call CFIUS. You know about CFIUS, Committee for Foreign Investment in U.S. companies. The president has the ability to block acquisitions of U.S. companies that pose a national security threat. And we were all wondering if Donald Trump would, because he's pro-business on the one side, wants to encourage trade, but he's like, anti, free trade on the other side, or anti-China, some might say. Well, he blocked this acquisition of this company. And it's pretty significant because it kind of signals that the administration is willing to do stuff like that. It's a really bad thing, I think, for trade, inbound trade from China. So that's one of the issues you have to think about when you have foreign investors. Is it going to affect your government contracts? Are you going to implicate a bunch of, since you got me started on this, there's no securities law problem. There is those two problems, and the biggest problem is anti-money laundering, especially these days. If you're going to take foreign money, you you really better make sure the money is clean, right? And there's ways of doing that. But certain countries that I won't mention here tonight on videotape are much more suspect in that regard than others. But yeah, be careful about foreign investors. I mean, if they're from Canada, then fine, who cares? You know, it's Canada. They're almost us. If they're from other countries, and in some countries, it's just flatly prohibited. That's what they call the OFAC list, Office of Foreign Asset Control. You cannot take money from North Korea, for example. It's way more than you wanted to know, I know.
Thank you.
What's not to mention in the pitch deck to be 506C compliant?
I'm sorry?
We present a pitch deck to the investors. So, a pitch deck.
You presented a pitch deck, yeah?
Right. What's not to mention in that pitch deck?
Oh, okay. You were talking about the pitch events. The deck, in your deck, you can certainly have, whoops.
Can you mention the budget and...
So in your deck, you can certainly, well, okay. As a securities law matter, you can certainly in your deck mention pitch your securities, the sale of securities. You can tell people what you're selling, how much you're raising, what your valuation is, all that stuff. That is securities compliant because that's a private conversation. That's a private offering. What you don't do is get up in front of the public, and tell people that because now you're offering it to the public, and that's a solicitation. And that takes you out of the private offering exemptions. And you got to find another exemption like this 506C. Having said that, however, I think it's a bad idea to put your valuation and to put a lot of information about that into a pitch deck. I think it's a bad idea. I think you take that conversation offline with your investors. Because once you put a number on the table, I have a VC friend, he tells me, he sees that, two things. He says, number one, I'm dealing with a newbie. And number two, whatever number they put out there, I just automatically cut it in half. They say we're worth $10 million, I automatically think $5 million. So he says, tell all your clients, don't give me a valuation number. Let's us talk about that.
And in one of your slides, you mentioned no transaction-based compensation for angel list. What does that mean?
Yeah, this is complicated, but under those so those SEC rulings, the angel list ruling, here they are, the no action rulings, had to do, were really under broker-dealer rules. And what they were really getting a ruling on, does everybody know about the broker-dealer law? So here's the broker-dealer law. If you hire somebody to go out and raise money for you, you hire them to broker a deal, they have to be registered with FINRA as a broker-dealer. So, or the SEC as a broker-dealer. And one of the ways that the SEC determines who's a broker-dealer is if they get transaction-based compensation. So if you hire me and say, hey, I'm going to give you 10% of all the money you raise for me, the SEC would view me as a broker-dealer. There's a lot around that, but that's the basic idea. So this no action letter, Angel List, wanted to go say, look, we're matching investors with companies on our website, but we don't think we're a broker-dealer. And so the SEC said, okay, you're not a broker-dealer as long as they go onto the website, they wait 30 days before they can get into a company. And oh, by the way, no transaction-based compensation. That's all we meant by that.
But there are some marketing companies, let's say we put our campaign on Kickstarter, they will do marketing for a certain percentage of... That's
not a sale of stock, though. It's Kickstarter. That's not equity. That's just rewards-based. It's fine.
That's still legal and it's
That's
okay,
legal.
right?
Yeah, it's only when you're selling securities that you have these broker-dealer rules. So you can do that with non-securities, like sales commissions. That's fine.
Okay, thank you.
Yeah. By the way, everybody, be really careful about that. I think everybody now knows. I want to talk about broker-dealer. So there was a time in the Valley when there were finders running all over the place, and people would raise money for you for a percentage of the funds raised. The SEC over the last 10 years has just really cracked down on that. But now California responded by enacting its own finder's law. In fact, I'm a registered finder. just, I don't know, for the hell of it, since there's a law. And California law is that if all you do is find money, you can take a percentage of the funds raised. You don't negotiate the deal, you don't do any other sales activities, you don't effect transactions and securities. That's a state rule, not a federal one. So you still have to worry that somebody is, is going to violate broker-dealer if you pay them a percentage of funds raised. Yes, sir.
All right. Not related at all to my startup idea, but to my new hobby. I'm looking at about 100 different coins right here on Bitrix. Don't even know what any of these things are. But do these pretty much represent like companies that are like funded, crowdfunded companies? Is that what a lot of these coins are?
Some of them are not even companies.
Yeah.
Dow is not even a company. The one that had the big SEC ruling, they didn't even form a company. It's just contracts.
Right. So is there like any way that I could like find out like which of these guys are like actual, like, like you were saying, coins that are like backed by a company that are like an investment? Like
any other security. You just got to do your due diligence. So what you do, the way it works is...
Is there any kind of platform that allows me to dig into these things? Because this doesn't tell me much of anything, really.
I think that's a good business idea, if there's not one already. I'm sure there is, but what you do is you look at the white paper that they file. It tells you what the coin is, what it does, what you get for it, and then you look at the PPN that says, and this is a team, and this is their track record, and just like any other security.
Yeah. Okay. Well, he's got a lead for me. Back
Okay, good.
Cool.
Oh, really? I'd like to know too.
6 months ago.
Huh?
A startup to help people like himself evaluate ICOs.
Really? Okay. Well, I'd like to know that as well, so email me.
Just a few questions for you. If your investors, latter round investors, consider your crowdfunded, let's exclude ICO, as sort of tainting the funding of the company, any way to buy them out? Crowdfunded investors.
I don't believe you can make these securities redeemable. I don't think you can. I know that's a really good question, and it is buried in the regulations. And I don't believe that you can, but I would not want you to quote me on that until I have a chance to go look. There was a time when I did carry that around in my head, but I don't remember, because that's not the first time I've gotten that question. And no, I don't think there is. That's the nature of stock. Well, here's a bigger question. Who would buy that security? Let's say, I think that's the answer. I think that's why we don't do it. It's because that makes it a very, it's not very attractive then. I mean, you buy stock so you can ride up the appreciation. And if you're going to say, oh yeah, you have to buy the stock, but I can buy you out anytime I want, so you don't get the benefit of the appreciation, no one's going to buy that. So that's where I came out of it.
So you can't precondition the crowdfunding.
You can, but no one will buy it. Because you have to just put that big red letters, remember? Seller beware. Gee, did you know that there was this redemption right? Would you have bought this if you'd known?
Okay. Title II costs, if you were to ballpark it, other than any commission or variable fees, if you added all your legal, accounting, and so forth, what would you average those to be?
Title III or Title II?
Title II, excuse me, Title II.
The accredited only.
Yep.
Okay, is it the solicited or non-solicited?
Can you give me an average for both?
It's kind of like asking how much does a house cost.
Yeah, I know. Yeah, I know. Ballpark.
I have done, okay, let me give you the variables. That's what I usually do. And by the way, when I work, I give people a statement of work, and I say this is the budget, these are the variables. So if you have 10 investors, that's way different than having 100 investors. 10 investors, and $1 million, we'll do that. And if it's a safe instrument, we'll do that for like $10,000, right? If you have 100 investors, it's going to be 30 to 50. It's just, and that's because if they're in different states, you got to do state compliance. I really can't, because it depends on what states they're from, how many investors, how much you're raising, and what the security is.
Okay.
I will tell you, just to give you some perspective, because I don't want you to walk away without any answer. I do fixed fees on this stuff, and I'll tell people, if you're selling one person, one safe, all I have to do is draft a safe. I've got to do blue sky. That's state securities law compliance. We got to update your ledger. We got to do some board consents. So, you know, you're under $1,000 for that one. If you're going to do 10 of them, now I need an agreement, you know, a purchase agreement. You're closer to $5,000 to do that many. If you're going to do more than that, costs start to escalate. And that's on the high side. I usually come in way below that, but that's what I tell people.
Okay, thanks. When we talk about not advertising for certain forms of crowdfunding, what is permissible ways of communication that's not deemed advertising to reach investors?
Okay, so for Title III, you just list it on a portal, on a platform. So people go to the portal can advertise. You know, I'm in a gazillionaire fund. That's a real portal, by the way, gazillionaire. And so people will go to the portal, and they'll scroll through, and they'll find your company, and they'll go in and look at it. But the company can't advertise, okay, the sale on security. Then there's Title II, 506B, no advertising allowed. And there's Title II, 506C, accredited only, you verify and you can advertise, and that's anything goes, as long as it's not misleading.
Sure, where there's no advertising allowed, what kind of communication can still be done? I mean, obviously you got a person calling a second person, point to point, person to person, that's obviously
Yeah, it's introduction, it's pre-existing relationship, it's face to face. There are close cases, no doubt. So the close case you should worry about where companies get in trouble is when they start putting stuff on their website or putting stuff in their pitch deck that I guess I can tell you this. I got a client right now that's at a big, humongous conference in Las Vegas, and you know, he's going to go present his wonderful product to all these people. I said, you better let me take a look at that pitch deck. And there it was on the final slide. You know, oh, we're in Series A, and we're doing this. Said, you better take that slide out, or you're no longer in Series A. But where people really get in trouble is on websites. They'll post something. We're raising money. Call me. You know?
And then on the other crowdfunding sites, do you seem to be more in favor of, like Funders Club and Angel List? There's no transactional fees, but what do the fees tend to be?
Yeah, there was a time when I knew this off the top of my head, but I don't. If you go online, you could probably figure it out. They're not so much that I would remember it. Let me put it that way. They're relatively modest compared to what they're doing. Okay. I mean, they're small compared to what the Title III guys are charging.
Okay, thank you.
Just a clarification regarding the 506C rules, where you say that if you put something in the pitch deck saying that, hey, this is the valuation we are trying to raise money. You mentioned something about the 6-month rule, and the other question is regarding if the pitch deck is for closed audience, is that okay? And how do you actually say that, hey, do you put something like, hey, this is confidential information in the pitch deck?
Okay, 6 months is a bright line rule. That's an integration rule. So any securities that are sold within 6 months of a public solicitation are presumed to be, you know, part of the so once you solicit, then you're doing a 506C. You're doing a publicly solicited offering. Any securities you sell within that 6 months are going to be presumed to be part of that offering. Okay, so that's why I say you got to wait and start all over. For a lot of startups, 6 months, like I say, it's a death knell. You can sit around and wait that long. The other part of your question, and that's an integration. Okay? That means we integrate, we kind of combine, clump different offerings together and call them one. The other part of your question was, what was it again?
If you have that information, like valuation and the fact that you're raising money in your pitch deck,
Yeah.
could you put...
Oh, what's a closed group?
Yeah.
Yeah.
Can you say that this is confidential information, not for public viewing, just like certain
Well,
documents?
Again, let's use an example. A small group like this that you have to pay an admission fee to get into, well, we're videotaping it, so that makes it public. If it weren't for the cameras, I wouldn't worry too much about this group. It's a small number. Suppose people could walk in here, anybody could walk in off the street at any time. Then I think it is public. Then I think you're taking a risk if you put anything about your valuation in your pitch deck. I think it's better safe than sorry. So the disclaimer I have people sign goes into that pretty great. It's not only, by the way, there's a lot of other things too. It's like, you know, I don't want anyone suing me if your representations turn out to be wrong. I don't want anyone thinking I'm brokering the company. But the one that you guys really need to worry about, because this is the one that everybody blows this. It's so frustrating. I did a pitch event last week for health tech. I hope nobody's here. And I was extremely clear. I said, please do not offer the sale of your securities, because there's like a public audience. And like half the companies, oh, and we're selling Series A, and this is our valuation, and this is stock price. It's like, everybody makes that mistake. It's almost irresistible. So if you take it out of your pitch deck, you won't make that mistake.
Last question. Excluding ICOs, we talked about crowdfunding, being careful about how it affects future rounds of financing. However, there's always the exit also for your startup, and we always think about that. So how does it taint or inhibit exit strategies based on crowdfunding?
Well, I hate to be Debbie Downer, but if you're going to do a stock for stock deal, that's going to be your exit, and you crowdfunded the deal, that means you got a whole bunch of non-accredited investors. And that's going to make a stock for stock deal not much more difficult, because the buyer now is a seller of securities to unaccredited investors. That's your existing shareholders. So they got to find an exemption. And I have had deals crater because of that. I had two or three of them, we had to go get a permit from the Securities Commissioner because there were so many unaccredited investors. So you're absolutely right. It's going to limit your if it's a cash deal, who cares? But it's going to limit your acquisition options.
How about IPO?
It doesn't matter except for if any problems come up in due diligence. Because an IPO, you got 1 million unaccredited investors theoretically anyway.
Thank you.
Hello.
Hello.
I'm not sure if you mentioned this, and I might have just missed it, but is there a limit amount of funds that you can raise through an ICO? And
Sky's the limit.
Sky's the limit, okay. And then the other question that I have is, if ICO can be treated as securities, what are the benefits of raising capital through ICOs versus a mini IPO or et cetera, et cetera?
Good question. So, but let me go back to the first one. I shouldn't say sky's the limit. Let's just say same rule as any other security. So remember, there's a utility tokens, not a security, maybe not a security, and the security tokens. Let's focus on the security tokens, subject to all the usual limitations on any other offering. But it could be unlimited unless you're in Reg A or if you're in Reg CF that we talked about that have these dollar amounts. If you're a Reg D offering, then yeah, sky's the limit. I forgot the second part of your question.
Oh, what are the benefits of raising capital?
Well, that to the company it looks like free money because they're not giving up any equity and they're getting money, and they're creating a currency really out of nothing. It's like magic. So the company feels like it's really cheap money. Well, they have to give up something. They give up some sort of utility. Maybe it's services. Maybe it's a pre-sale. I've got a couple of them. It's really their token offering is really just a pre-sale of product. Or maybe it's a share of some future revenue, a share of the appreciation. So it's the benefit is it's a really cheap way for a company to raise money because you're betting on the future. So the investor is betting on the future appreciation of the token. All got green in our eyes because we've seen what happened to Bitcoin. So that's the benefit. It's cheap money to the, you know what it's like. I was thinking about this today. Is anybody here around during the dot-com days? This is like dot-com on steroids. Remember the bubble? People were walking around saying, oh, there's such a big bubble because those two kids in a dorm room, they raised, $10 million. Well, those two kids in the dorm room are raising $100 million with this, and there's even less behind it than that PowerPoint they had before. So I predict you'll see either a massive crash or a massive shakeout in the market, which is what markets do, winners and losers, where you'll see the government just step in and shut the whole thing down. You look what New York State did to Bitcoin. Just watch what they'll do to this. But there's a huge opportunity right now, that I have to admit.
Let's give it up for Roger.
Thanks very much.